I welcome all the members on the behalf of Amritsar branch of NIRC in this virtual meeting. I take this opportunity to convey all the members that today in this virtual meeting, very intelligent person and eminent speaker CA Prashanth Vellanki, Bangalore, has joined us in this knowledge sharing session on auditing. In this session, we will be having deep insight about the standards of auditing, 700 series, common errors in audit reports, and the company's auditors report order 2020. The independent auditor's report on financial statement of an entity lends credibility to the financial statements prepared by management of the entity, since audited financial statements are relied upon by the various users of the financial statements. For example, shareholders, creditors, investors, regulators, government agency, and other users. It is essential that audit reports convey the auditor's opinion on the financial statement in clear and unambiguous manner in order to serve a meaningful purpose to these users. Today's session is utmost important for all the members, as all of us know any little error or omission in this part of reporting may lead to serious issues for the certifying members as well as auditees. I welcome eminent speaker of the Vellanki from Bangalore on the behalf of research, who will deliberate on the topic of standards of auditing and Caro Audit 2020. We are thankful to you, sir, for sparing your valuable time for us. Now I request our chairman, CA Sanjay Arora ji, to kindly say a few words.
Thank you, Shashipal ji. Keynote speaker of the day, CA Prashanth Vellanki, esteemed professional colleagues, office bearers of Amritsar chapter of ICSCI, good morning and Ram Ramji to all of you. I warmly welcome you to today VCM on standard of auditing 700 series to be taken by Prashanth ji, who will make us aware about common errors in audit reports and company's auditor board Audit 2020 as well. Member branch is organizing VCM on faceless assessment scheme, faceless appeals, and export of CA services in the coming weeks. I would like to gently remind you for updation of particulars in each directory of members, as we are also considering the compilation of student directory also. I congratulate to newly appointed NICASA team members and look forward more and more student-led activities as soon as the exams of November 20 ends. I assure the newly NICASA appointed team best of the cooperation from our executive members at all the times. I do hope it will be a wonderful and informative session. Thank you. Thank you so much.
Thank you, Sanjay. Before start, I would like to introduce our guest speaker of the day. Prashanth is a fellow member of ICI, member of Association of Certified Fraud Examiners, and associate member of Institute of Internal Auditors. He has honors degree in commerce from Shri Ram College of Commerce, Delhi, diploma in information audit, in information system audit, and certificate in IFRS and ACCA. He started his career with Grant Thornton, a leading financial advisory firm where he specialized in financial statements, audits, and assurance as per various reporting frameworks, including Indian GAAP, IFRS, Singapore GAAP, etc. He then co-founded ProLead Financial Solution 2012. ProLead Financial Solution Private Limited is a financial services company specializing in the area of audit and insurance, taxation, and corporate advisory services. Apart from being a co-founder, Prashanth is a principal consultant at ProLead. He leads AAA audit and insurance and corporate advisory meetings, specializing in the areas of process review and enhancement services, internal control assessment, financial statements audit, and advisory services. He handles a diverse portfolio of clients across sectors such as services, technology, manufacturing, hospitality, retail, and pharmaceutical research. From being co-founder of ProLead, Prashanth is a visiting faculty and guest lecturer at various management colleges and professional training institutes, conducting sessions for students undergoing MBA, PGDM, Associate of Certified Chartered Accountants, ACCA UK, CA, and CS courses. He is a partner GVNK and Associate Chartered Accountants. He has teaching experience in JGI, MBA, IDEA program, Fundamentals in Finance, Sourcing of Finance, Financial Reporting, Budgeting, and legal aspects including taxation, new venture creations, entrepreneur talents, opportunities, financial management, and business taxation. Without taking much time, this is the introduction of our guest speaker, and without taking much time, I request Prashantji to start your session and enlighten us on today's topic of standards of auditing, 700 series, and on CARO 2020. Over to Prashant.
Thank you, Shashiji, and thank you, Sanjayji. Good afternoon, everyone. It's my pleasure to be in the midst of you all this morning. It's an honor addressing you all through this virtual meeting. I think one of the very few positives that have come out of COVID is that it's pushed us to adapt technology much faster than we would have liked, and thereby giving us this opportunity to meet in this virtual session. Like Shashiji rightly said in his introduction on the topic, it's a very relevant topic of the day because there have been a lot of changes in terms of our standards on auditing. Then there's a new CARO which is introduced. A quick context on why these changes are or what led to these changes. So if you look at it, these changes have been in the pipeline for some time. Essentially, the genesis of these changes essentially is from the GFC, that is the global financial crisis of 2008-9. And then closer home, also we've seen a lot of fraud starting with Satyam and the most recent ILNFS, where in all of these scams or fraud, the role of two parties have been in question, one being the credit rating agencies and second being the auditors. The role of auditors and CRS have been critically evaluated in these scams. So now we can't speak for the credit rating agencies, but if we look within ourselves, as the role of auditors has been in question as far as all of these scams are concerned. Now, some people have identified that is because of an inherent conflict, because you're essentially auditing a particular company and the auditee is the one who is sort of remunerating you. So some of them have identified that to be the case. Be that as it may, I'm not going to debate on if that is the reason why sort of these reporting deficiencies have been identified. But there's also another thing that comes out through all of these. If you look at ILNFS or any of these scams, there's also an expectation gap. What the users of financial statements are expecting from us versus what is it that we are giving in our audit reports. Now, for example, in our audit reports, we give a reasonable assurance. But do the users really understand what reasonable assurance is, or are they looking at absolute assurance? So we say true and fair, but how many of the users of financial statements really appreciate the concept of true and fair? So they look at the audit as an absolute assurance of the underlying financial statements. So there's a huge expectation gap between what we give out versus what the users are expecting from us. And as far as we are concerned, we always look at audit reports in the form of a boilerplate text. When I say boilerplate text, essentially you have one format set and you use the same format across various companies, right? So which curtails the ability to make it very relevant. And then I don't envy the role of the standard setters here. So where they have to make it very relevant, they have to make it very entity specific, but at the same time, it has to be standard. If we don't have a standard form of the audit report, then each member would report in their own form, right? Which would again go to dilution of objectives, audit objectives. So how do we balance the two? And the changes that have taken place, be it in the essays that have come in or in the CARO, I think it's the first step in that direction, where we are sort of trying to balance the two, balance the objectives of the audit versus what is the user expectation. So I'll move on to the 700 series, the standards on auditing, which are there in SA 700. Now, essentially, these have been revised. Like I mentioned, this has been there in the pipeline for some time, and it was effective financial year ending 31st March 19 that we've had these new audit reports. So all our audits which we had reported on for 31st March 19, we had essentially reported after incorporating these changes. So let's quickly look at what are the key changes and how does the standards, what do the standards incorporate as of now? And then I'll probably move on to the CARO bit later. So if you look at the SA 700 series, essentially we have 6 standards. Now, while I say 6 standards related to reporting, there are also other standards like SA 570 coming from going concern assessment that will take up separately. But when we look at SA 700 series, essentially we're looking at 700 being the forming of opinion and reporting on financial statements, which is what I call the baseline standard. So your entire crux of the audit report is coming from SA 700. Then 701 is a new standard, which was only introduced effective last year. Now, this talks about the key audit matters. As of now, the applicability of key audit matters and reporting thereon is restricted to listed companies. Then we have 705, which is about modifications to the opinion in our audit reports. Again, this was revised effective last year. Then EOM and other matter paragraph, again, there's been a significant revision here. Members would know that other matters is something that was not there earlier, but now that's been added. In addition to EOM, which was always there, emphasis of matter, now we have something called as other matters also, which are included there. And then comparative information, which has been there. And 720 is again a new standard. So essentially, if you look at it, 700, 705, and 706 are revised. Then 701 and 720 are new. So 701 being key audit matters, and 720 is auditors' responsibilities relating to other information. Now, what do we mean by this other information? Essentially, information contained in the annual report of a company. Now, we are giving out the financial statements, but a lot of financial information is also included in the annual report. What if they are not in sync? What is the auditor's responsibility related to that? Because it can so happen that a lot of people are making a decision on the basis of information contained in the annual return, whereas we have actually given out the financial statement. So at some point, the regulators would want to fix the accountability on us to ensure that there is consistency between what we are signing and what's included in the annual reports. That's SA 720. Now, like I told you guys, the base standard is obviously SA 700. And the objective of all of these changes, essentially these changes are brought about by IAASB, which is the International Accounting and Auditing Standards Board. So it's a member body of IPAC, and ITA has adapted these changes into our standards on auditing. So the objective of these changes again is to make our audit reports more informative and more relevant. Like I told you about the boilerplate approach, we can't probably have that approach across. If we have that approach across, somewhere down the line, we are missing some reporting aspects, something that is very key, because the user ought to know what is it that which became the basis for you to conclude. If you have arrived at a particular conclusion, audit conclusion, what is the basis for that audit conclusion? When you're saying I'm only looking at a reasonable assurance, the user should know what you mean by reasonable assurance. So so the first objective is to ensure that the audit reports are more informative and relevant. And obviously, this is very critical to the relevance of auditing profession. If we don't understand the needs of the users of financial statements and report accordingly, the relevance of auditing profession itself will be in question. So all the regulators are hoping that these new changes will become the foundation for, the development of audit profession globally. So if you look at the key enhancements that have been made, essentially for listed companies, they've added something called as key audit matters. That is what SA 701 deals with. Now, what are these key audit matters? Again, the objective is to report on the basis of which you arrived at certain judgments, on the basis of which you arrived at certain conclusions. So essentially what's included in key audit matters is, it could be your estimates, right? So, or when you're auditing your provisions, on what basis have you arrived at this? On what basis have you concluded that what's there in the financial statements is appropriate? So this is something that we need to disclose as a separate section. But like I said, as of now, key audit matters is applicable only in case of listed entities. Right now, for unlisted entities, we only have other matters, which I'll discuss separately. So key audit matters is for listed entities. Now, for all other reports, essentially the structure of reporting has changed. So if you compare the report that we used last year with the one that we used to use earlier years, the opinion section has come on top. So earlier the opinion section was the last, right? So, but last year it was opinion section first. And then you have a new paragraph called basis of opinion, which was not there earlier. So they've added that basis of opinion very clearly with a separate subheading saying, this is the basis on which I've arrived at this opinion. Then there's also a lot of emphasis on going concern. Now, whose responsibility is it to assess going concern? Again, the primary responsibility is of the management. So again, that aspect has been brought into the report itself, where the report highlights that the primary responsibility of going concern assessment is the management. The auditor needs to evaluate if that assessment is appropriate or not. And when there is a material uncertainty, how is that to be treated in the audit report? That is something that has been incorporated. Then there's a lot of emphasis with respect to demonstration of audit independence into the audit report itself. Then enhanced description of responsibilities of the auditor. Like I mentioned, it is very important for the users to understand what's our scope. If that is not very clearly set out, then there are these expectation gaps that would come in. So there is an enhanced description of the responsibility. So we look at all of these. So this is a quick summary of the changes that have been done. So SA 700, again, to highlight and draw attention to the audit work and to the management's underlying responsibility as far as going concern and etc. 705 is about key audit matters. Key audit matters relating to modified opinion. So you already had SA 705 relating to modified opinion. Now, what is the interplay between that and key audit matters? That's 705. 706, we had emphasis of matter earlier. Now, other matters also added into 706. Then 701 is completely new, which 20 is about information, auditors' responsibility towards other information coming in annual reports, etc. So then we'll start with SA 700, which is what I call the baseline standard, because essentially our audit report is based on this, and then the modifications and all are dealt in separate standards. So if you look at the baseline standard, essentially talks about what is the auditor's responsibility. So obviously our responsibility is to express and form an opinion on the financial statements based on the audit. And then this also gives out the form and content of the audit reports. And this deals generally with the general purpose financial statements, and not specific purpose. You have a different format. Now, again, SA 700 deals only in case of unmodified opinions. The moment we are modifying an opinion, it gets covered under SA 705. So 700 is the baseline standard for an unmodified opinion. Now, SA 700 very clearly states that obviously we need to obtain reasonable assurance. Now, when do we say we've obtained reasonable assurance? One is we need to have sufficient and appropriate audit evidence, and thereby, based on this audit evidence, we have come to a conclusion that the uncorrected misstatements are not material. Now, if you look at the new standard, very clearly says that this is something that you need to demonstrate in the audit report, right? So in the fair presentation standard framework, again, this has to be demonstrated in the audit report. And in addition to that, if you're looking at a fair presentation framework, in addition to demonstrating how you arrived at reasonable assurance, we also need to look at, has the entity followed a fair presentation framework? Now, what do I mean by fair presentation framework? Where the disclosure is open to the management and auditors. Now, what do I mean by disclosure is open to the management and auditors? If you look at the way our accounting standards are, the way our revised schedule 3 is, it is not a strict rule book based approach. It gives a guidance as to how I should present. So, but the disclosure can be more than that. And that is why in a fair presentation framework, so the contrast to this would be something like the information that we are giving out in our 3CD. Now, 3CD, the information is very specific. This is what is needed. This is what I'm giving. But financials are prepared under a fair presentation framework. Now, when you're preparing under a fair presentation framework, obviously there could be enhanced disclosures that can be added to improve the value of the financial statement. So the auditor also has to look at the overall presentation structure and content and how these are reflecting the underlying transactions. It's not a very checklist-driven approach, but they'll have to look at and form an opinion if the underlying transactions are very clearly reflected in the overall structure. So these are the changes. This is the comparative with respect to the earlier structure versus the revised structure. So like I'd already mentioned earlier, we had something called as an introductory paragraph where we would identify the company and the financial statements. Now we are directly moving after the title, address, and subtitle. We are directly moving to the opinion paragraph. And immediately following the opinion paragraph, you have a new paragraph now called the basis for opinion, which was not there earlier. And then you have management's responsibility, including those charged with governance. This could be typically in case of larger companies which have a specific dedicated audit committees and other committees of the board. That is where we'll have to bring in those charged with governance in. And then auditor's responsibility. And then you have other matters, EOM. So those are, it's a change in the structures. But the key takeaways from here is that the larger emphasis is on the opinion and the basis of opinion, the basis for opinion. So how are we bringing more elaborate description of responsibilities? Now, first and foremost, going concern assessment, how is it dealt with? Again, the responsibility of going concern assessment is again predominantly of the management, and that is something that we are explicitly stating right now. So on the face of the audit report itself, we are very explicitly stating that going concern assessment is management's responsibility. And then what is our responsibility as an auditor? We are evaluating if the management's assessment is appropriate or not. And then again, if how we are communicating with those charged with governance and all of that is brought in. So this is as far as the management responsibilities go. Now coming and focusing more on the auditor's responsibilities. So in the auditor's responsibility section of the audit report, we have to very clearly set out objectives of the auditor. Again, the logic behind this is going back to the genesis of where we started. It's the expectation gap. What is it that we are reporting on, or what is it that we are reporting for, versus what is it that the users are expecting us to report on? So we need to very clearly state the objectives of our audit, which includes the fact that we are only obtaining a reasonable assurance, and the fact that reasonable assurance is not an absolute assurance that has to come in. So we need to state that while reasonable assurance is a high level of assurance, it is not that it's not a guarantee that we are providing. So this is something that has to come in onto the face of the audit report. And then we describe how frauds and errors can happen and how we are designing our audit procedures to identify these frauds and errors. But the critical takeaway here is about reasonable assurance and define that reasonable assurance is a high level of assurance, but at the same time, it's not a guarantee that we are giving to the users. Then the next thing is about how we are demonstrating and maintaining professional skepticism, how we are sort of maintaining our independence. And in this context, we'll also talk a little bit about our audit procedures. So if you look at the paragraph where we talk about responsibilities of auditor, after the definition of reasonable assurance, we also need to very clearly mention what risk of material misstatement is. So ROMM would mean risk of material misstatement. So how are we trying to identify that? How are we designing our audit procedures to identify a possible risk of material misstatement? And then we talk about how we ensure that we are developing an understanding of internal controls, how we are designing our audit procedures around it. So this is there in the improved description of auditor responsibilities. In addition to that, we also need to talk about scope and timing of our audit procedures very broadly, and we need to communicate key audit matters to those charged with governance. So that's broadly the thing. So I think there's one important aspect of other reporting responsibilities. This talks about a specific section in the audit report, which is report on other legal and regulatory matters, which is what will sort of give a report on the basis of the Companies Act requirements. So all the Companies Act requirements, including those in the section 143, is what we are covering under legal and other regulatory requirements. So key takeaways from 700 is that obviously the description of auditor's responsibility has to be more clearer. The opinion point and the emphasis on the basis of opinion. So these are the key changes as far as 700 is concerned. But this is the most important standard practical. So when we look at if we come across a possible material misstatement in audit, how do we deal with it? So all of that is included in SA 705. So let's look at SA 705. But before we do that, I want to very quickly talk about three types of modification, because there's a lot of times we use certain words interchangeably. But modifications would mean only three things. There are some questions which I'll probably take up after the essay series are done before I take up the Caro part. Yeah, so we'll start with the modifications. Yes, so there are three modifications. One is it's a qualified opinion, or it's an adverse opinion, or a disclaimer opinion. There are only three types of modification. A lot of times we think likely that there's a material misstatement. Can we include an EOM? EOM is not a modification to the audit report. An emphasis of matter, you're just drawing users' attention to something that's already disclosed in the financial statements. So an emphasis of matter can never be a substitute for your modification. So essentially modifications are of three types: qualified, adverse, and disclaimer. Now the issue is, when do we modify? Before we get into when does it become a qualified opinion, when does it become an adverse opinion, or when does it become a disclaimer, what are the situations where we are supposed to qualify the audit report? One is based on the evidence that we have already obtained and evaluated. We have concluded that the financial statements are not free from material misstatement. In other words, based on the evidence, we have concluded that there is some material error in the financial statements. So we've evaluated it and it's more than our tolerable limit, and basis that we've concluded that there's a material error. That's one part of it. But complexity comes in when you're not able to obtain evidence. So the first part where you've already concluded that there's a material error is easy to report. It can only be two of these. I'll discuss later. But the second part is it could also be a situation where you're not able to obtain enough audit evidence. Then how do we deal with that? So essentially the matrix here will provide some guidance on that. So when we're looking at something where you've concluded already that financial statements are materially misstated, we have two options. One is qualified and second is adverse opinion. Now between the two, the difference is an item which is material, is that pervasive? Now what do I mean by pervasive? Is that prevalent across various cycles of financial statements? So let's say there could be issues with respect to the way inventory is reported, and that is material. Now, is that issue only restricted to inventory, or have you seen a similar issue when you're looking at fixed assets? Have you seen a similar issue when you're looking at your debtors? So when you see that similar issues across financial statements, that is when we say it is pervasive. So a material misstatement restricted to one particular cycle is material but not pervasive. That is when I would give a qualified opinion. that is when I would say the financial statements are okay, but subject to this. The wording we'll discuss later, subject to this particular area. Let's say inventory, there's an issue. So except for the issue under inventory, all other areas are fine. So that's what is qualified opinion. But what if the same material misstatement or the way in which this misstatement happened, that is pervasive across financial statements? Same type of errors are likely to happen, or they've happened across financial statements. That is when we issue an adverse opinion. So adverse opinion is two things you need to ensure before giving out an adverse opinion. One is there are material misstatements, and B, material misstatements are spread across financials. If material misstatements are identified but restricted to one cycle or one account head, that is when we are looking at qualified opinion. So that's qualified versus adverse opinion. Now, this is where you have concluded. But what if we are not able to conclude? It could be because there's not enough evidence, or it could be because management has imposed certain limitations on us to report. Again, that is where we need to have to evaluate. There are two options there. One is a qualified opinion, and second is something called as a disclaimer of opinion. Now, qualified opinion is where you have obtained some evidence, and you, on the basis of the some evidence that you obtained, you could conclude that yes, there is a material misstatement, but that is not likely to be pervasive. That means to say, wherever you have not obtained evidence that is restricted to one particular cycle, again it becomes qualified. So example would be, everything else is fine with respect to fixed assets. I couldn't gather enough information about the supporting documents. Then again we're looking at a qualification. But this inability to obtain sufficient and appropriate audit evidence is spread across various cycles, whereas it extends beyond, let's say, fixed assets across to other cycles. That is when you give a disclaimer of opinion. So disclaimer of opinion would typically be, there is a scope of audit, and because of certain restrictions imposed, you're not able to carry out your procedures. That is where we are looking at a disclaimer of opinion. So essentially three types of opinion I want to summarize. One is a qualified opinion, second is an adverse opinion, and third is a disclaimer of opinion. Two situations where a qualified opinion is issued. One is where it is concluded that there is a material misstatement, but that is not pervasive. I issue a qualified opinion. Second is where I was not able to obtain sufficient appropriate audit evidence relating to a material amount or an account, but this is not spread to other cycles. This restriction on evidence is only one cycle. Then again, I issue a qualified opinion. Adverse is where you've concluded it is material and it is prevalent across various cycles. That's when I issue an adverse opinion. Now, disclaimer is when you are not able to conclude essentially. So you have not got evidence not just for one cycle, but for multiple cycles. That is where we issue a disclaimer of opinion. So these are the different types of opinion. Like I said, 700 is a base standard where it talks about the auditor's responsibility, format, and etc. But 705 is something that is very important for all of us to evaluate. Our reporting, our modifications are all governed by 705. And like I said, there can only be three types of modification. There is no diplomatic communication as far as audit reports are concerned. If it's a modification, it has to be either qualified, adverse, or disclaimer. There's nothing where maybe the client will feel bad, so I'll change the language. No, it doesn't work that way. It is only one of these three: qualified, adverse, and disclaimer. And the basis of determination of that we've already seen. Yeah. So obviously I've touched upon some part of this. We need to also look at how you've arrived at this material misstatement. Is it related to application of accounting policies, or is it related to disclosures, both of which could lead to a material misstatement? A lot of times we are under the impression that it is only the balance sheet, P&L, and the notes associated thereto, but not the disclosure. But yes, if there are inadequate disclosures, that could also lead to a material misstatement. Then inability to obtain sufficient and appropriate audit evidence. These are the cases where you either issue a qualified or disclaimer. Now that can arise sometimes because of situations beyond the control of the entity, sometimes because of the nature of the procedures that you plan to do, or sometimes just because of the limitations imposed by the management. So in each of these three situations, it is important that we use a professional judgment, and basis that we decide, should it be a qualification or should it be a disclaimer of opinion. So management imposed limitations. These are slightly tricky, where you've started the audit and there are certain limitations imposed by the management specifically. Again, typically prevalent in a lot of cases, especially under PSUs and all of that, where there are restrictions or they have imposed certain restrictions to access certain information and all of that. Now, how are you supposed to deal with that? Again, there is some guidance available as far as SOA 705 is concerned. So first, we need to communicate with the management at the first level and ask them to remove these limitations. Again, if the management refuses to remove the limitation, we need to communicate to those charged with governance. Now, that would typically be your audit committees. Even after that, if there's no way that the restriction is removed, then we need to look at if there are certain alternative procedures that can be planned to obtain evidence. Now, if you can plan alternative procedures, go ahead, obtain evidence, and then determine that is there a material misstatement or not a material misstatement, end of the story. But what if there are no alternate procedures that can be performed? This is where communication becomes absolutely critical. The standard says if the legal requirements or if the regulatory requirements, which could be your Companies Act and so on, if they permit you to withdraw, you have an option of withdrawing, but provided you communicate very clearly to the management and to those charged with the governance, place your objections as to why you are withdrawing and withdraw. But practically, there could be a lot of restrictions as far as C&AG regulations and all of that, where withdrawal could become difficult. In that case, the option is to disclaim an opinion, where you're saying because of these limitations that are imposed by the management on our audit, we're not able to express an opinion on the financial statements. That's how we do a disclaimer of opinion. So again, when you're doing a disclaimer on opinion, again, there's an additional responsibility. You need to very clearly demonstrate the fact that in the face of the audit report itself, in the manner of basis for disclaimer on opinion. Like how you have a basis for opinion, you have a basis for disclaimer of opinion. There you need to very clearly state that you are not able to obtain audit evidence. And then you include about your auditor's independence and ethical responsibilities. Can you issue key audit matters and disclaimer of opinion? No. When there is a disclaimer on opinion where you're not able to communicate on the financial statements itself, you're saying there are scope restrictions imposed on the way I carry out my audit itself, it becomes very difficult for you to go ahead and give a key audit matter section. So KAM is not required in case of disclaimer on opinion. So this is the standards on modifications essentially. So we've seen the baseline standard, then we've seen 705, which deals with modification. And again, I want to emphasize on the fact that there are only 3 types of modification. EOM is not a modification. EOM is something that we'll look at right now. So 3 types of modification being adverse, qualified, and disclaimer. So please be careful with respect to when we're using what. Disclaimer is only when evidence is not obtained. Adverse is when it is pervasive, qualified in other situations. Now EOM and other matters paragraph, again, like I mentioned at the beginning, there has been a revision in this standard as well. The significant addition is with respect to the other matters paragraph. While emphasis of matters was always there, other matter has been recently added. Now, first we'll look at EOM, which is an emphasis of matter. I want to reiterate the point that EOM is not a substitute for modified opinion. In EOM, essentially what we are trying to do is, there's a disclosure which is already provided by the management in notes. So there is something which the management has disclosed in their notes to accounts. And as an auditor, you believe that it is important to draw users' attention to that disclosure. And that is when we give an EOM. So EOM is not a substitute for your communication. If there is something that you would want to communicate, now you have an option to communicate in other matters. For listed companies, we have key audit matters. So EOM is essentially for the communication of the management. But as an auditor, you believe that communication to the management should reach out to users. So you are emphasizing. So you're placing a larger emphasis and you're drawing users' attention to that particular note that's already given by the management. So again, the interplay between EOM and KAM, again, KAM is something which the auditor is communicating to the users. EOM is something the management is communicating, and the auditor is just drawing users' attention to it. So examples of where I would give a EOM would typically be, let's say, on account of COVID. The management would want to give out a note as to the impact on subsequent events, because there's a standard which deals with adjusting events, non-adjusting events. So the management would want to give out a note in their financial statement saying how have they assessed what is adjusting event, what is not adjusting event. As an auditor, maybe it is important for you to draw users' attention to that note. So that is when you give an EOM, but that is not a communication from your side. Now there's a new section that's added called other matters. Now, what are these other matters? This is where you would communicate to the users, where you believe, as based on your auditor's judgment, it is relevant to the user's understanding. Now, this could include your scoping and planning procedures. Again, if I were to take COVID as an example, this can include cases where, let's say there's a physical verification that you ought to have observed, but because of COVID restrictions, you are not able to be there at the physical verification, at the point of physical verification. Now, assuming that inventory is a very critical and material cycle, you would want to probably communicate to the users as to how you have concluded on inventory. Now, for listed companies, you have key audit matters, but for unlisted companies, your planning, scope, timing of audit procedures, which you believe is very important to be communicated to the users, that is what we'll communicate through other matters. So going back to my example, if the management is putting a note on COVID, you want to draw users' attention there, that is EOM. But if you want to state because of COVID, there are certain procedures that you are not able to perform, that is where you would give an other matter. So two different things completely, and other matter is a new instruction. So relationship between EOM, OM, and CAM, again, very clearly, OM and CAM, these are auditors' responsibilities. These are auditors reporting with respect to how auditor has reached certain conclusions, certain critical areas during audit, how the auditor has dealt with certain important aspects during their audit. So that is what is communicated in CAM and other matters which we discussed. EOM is a management communication. So probably I'll take up some questions on the 700 series, and then I'll start with Karo. There was one question on if we are not provided with appropriate evidence regarding reasonableness of estimates used by the management, how should we proceed with the report? So again, Chirag, essentially what happens is, as it is, audit of evidence is difficult. So typically you have audit evidence to support everything else, but estimates, you're essentially looking at the reasonableness of it. So based on your evaluation, based on the relevant details available, if you probably look at, let's say you're looking at the going concern assessment itself, where there are a lot of estimates involved, right? So based on the information that you could gather, hypothetically speaking, let's say there are management estimates that are given, how you would settle off your liabilities in the next 1 year. Now you review that, basis the evidence available, if you can conclude that, yes, it is fine, there is no going concern issue here, there's no material uncertainty with respect to the going concern, you can just give a clean opinion without any qualification, and you can probably communicate this in your other matter, saying that there was an issue faced, but this is how I have resolved it. I've obtained certain other information and I've assessed the reasonableness of estimates. But if there is a situation where you're absolutely not clear on the estimates that they've used and they're not able to provide you any corroboration for the reasonableness of the estimates used, that is when you might want to bring that fact out and give a disclaimer. So it is about how you conclude. So in your conclusion, if you say that, no, it is fine, I can obtain certain other evidence, then you can leave it at other matter. But if you're not able to conclude, and that is when you look at a qualification or a disclaimer, depending upon what are the cycles that these estimates are affecting. I hope that is clear.
Sir, in case of entities other than listed ones,
yes,
for reasonable turnover up to 2 CR, 5 CR, 10 CR,
yes,
those which are not the listed entities, how could we reasonably assure the impact of COVID-19 disturbances on the financial statements in other matters and on the other than CAM issues?
Correct. So obviously, when you're looking at listed entities, the auditor will deal in CAM. Yes.
Also, as per sir, CAM is optional for the other than the listed entities. What will be the reasonable way to go for that, for these type of entities? Either we should go through CAM or through any other emphasis of matter.
So one is CAM, sir, but again, depends on what the management has done. If the management has provided their disclosures appropriately, you can always go for an EOM, emphasis of matter, where you can draw users' attention saying, due to this COVID, this thing, the management believes this will get affected or not get affected, and this disclosure is given in so and so note of the financial statement. That is, the management has given a disclosure. If the disclosure is not applicable or is not provided by the management, then you have two options. One is another matter, and second is key audit matters. Key audit matters, like you said, is only applicable for listed companies. If you want to voluntarily adopt it, you can. But my suggestion would be you can do it through other matters, because once you're doing key audit matters, you can't just restrict yourself to COVID. Then you need to bring out key audit matters relating to other cycles also. So rather than that, you do it as a communication through other matters paragraph. So you bring in another matters paragraph and say that these are the challenges that we faced, that were faced by us because of the COVID restrictions, and this is how we've overcome those restrictions. So other matters would be better.
Sir, beside that, doing this, sir, if in the last week of March 20, in which this lockdown started, if any entity of reasonable sales amount has lost some sales portion and reasonable profit portion, which is quite impacting on their financial estimations and on the balance sheets, Can't say a huge impact, but quite a major impact for the last few days on their dispatching and on their stocking pattern and on their sales portion. Can it be covered in material disclosure, or we should not go for the disclaimer of opinion for this? In my opinion, what will be the reasonable way to disclose the impact of those 7 days or 10 days of financial statement?
Correct. I got your question. So essentially, it is the management's responsibility to disclose that, sir. As an auditor, we need to mandatorily disclose only if it will have an impact on going concern. But the business impact on COVID, the preliminary responsibilities of the management. So what the management has to do, and this is what we are asking all our clients to do, is add a note in the financial statement saying what is the impact due to COVID up to 31st March and post 31st March also what is the likely impact. Right? So this is the first responsibility, which is of the management. If the management does it, then your job is to consider if an EOM is required. Saying the management has given a note already, should I draw users' attention there? If the management doesn't do it, then again you need to assess, is it that important that I need to bring out as a qualification, or it could be another matter? Now, qualification will only come in the form of a going concern. That is where you're saying that the impact is very big, and that impact is also likely to result in a material uncertainty. Now, we have a standard on going concern, sir, which deals with, is there a material uncertainty with respect to the business meeting its obligations in the next 1 year because of the impact of COVID? If yes, then that you have to bring on to the face of the audit report. So this is standard, sir, SA 570. As per that, you need to bring that material uncertainty part onto the face of the audit report, saying that because of COVID and for other factors, there is a possibility that the business may not be able to meet its obligations in the next 1 year. And hence you report that. So as an auditor, first, it's the primary responsibility of the management, and you draw users' attention there. If you believe there's a problem with going concern, that is where you proactively bring out a material uncertainty note onto the audit report.
Okay.
Yeah, any other questions there? Okay. Then we'll move to the next topic, which is CARO 2020. I think at the beginning of the section, then I said one of the very few things that are positives because of COVID is technology adoption. But the second positive could be the fact that CARO 2020 is deferred. If you look at the reporting responsibilities that are included in CARO 2020, there are a lot of enhanced responsibilities, additional responsibilities that are included in onto the auditor. And it was sort of notified on 25th of February. So which means there was no time whatsoever to prepare for this CARO. But because of COVID, essentially, they've deferred it by 1 year. As per the original notification, CARO 2020 is supposed to have been applicable for all the audits for the financial years ending 1920. But after COVID, again on 24th March, they've given a notification by which they're deferring it by 1 year. So now it is applicable for all financial years commencing on 1st of April 20. So that means to say for all our 2021 audits, CARO 2020 becomes applicable, and for all our older audits, we continue to do it as per CARO 2016. Now, a lot of significant changes here. There are a lot of new requirements. The number of clauses which were there in 2016 versus 2020 order has gone up from 16 to 21. But the most important part is if you look at the sub clauses. So there are about 40 sub clauses against 8 sub clauses which were there. Exemptions are retained as is, which we'll discuss in the next slide. And they've also included one clause which applies to consolidated financial statements. If you look at CARO 2016 and all the earlier versions of CARO, those were applicable only on standalone audit reports. But 2020, we have one specific clause which deals with consolidated financial statements. But first, let's look at the applicability. And like I said, this hasn't been changed. We still have the same applicability criteria. CARO is not applicable to banking, insurance, Section 8 companies, and certain other private companies based on the criteria which is there in the next table there. And then it's not applicable to one person and small companies. Now, exemption to private companies is if a private company satisfies all three of these, that is where the paid up capital and reserves is less than 1 crore as on the balance sheet date. And then the total borrowings are again they do not exceed 1 crore, revenue of 10 crore. So you have 1, 1 and 10. So you have paid up capital and reserves of 1 crore. Borrowings of 1 crore, and again these borrowings are from banks and financial institutions, and revenue of not exceeding 10 crore. So the applicability criteria and the exemption criteria, be it for 2016 CARO and 2020 CARO, remains same. Now, there are certain issues around applicability. We'll first deal with those issues. First, about paid up capital and reserves. Now, do we include share application money in your paid up capital? The answer is no. This is to align with the Schedule 3 definition of paid up capital. So, if you look at our Schedule 3 classification, paid up capital, and then you have share application money coming separately. So, paid up capital will not include share application money. What about convertible instruments, especially instruments like convertible debentures? Should you have to consider that? Because in some provisions under Ind AS, convertible instrument, to the extent that you identify the equity portion separately, you treat it as equity. But from a CARO application perspective, convertible instruments are not to be treated as capital as yet, especially the convertible debt instrument. Then what do you include under reserves? Again, unlike some of the other definitions, we don't have anything called as free reserve, statutory reserve, general reserve. It includes all reserves. So how do we sort of define this then? So it includes all the reserves which are coming under reserves and surplus. It could be in the nature of balance in P&L account. It could be a general reserve. It could be a specific statutory reserve in case of NBFCs, or it could be any other reserve, capital redemption reserve, whatever reserve it is. As long as it is under reserves and surplus, you would consider that to evaluate the applicability. So that's on the paid up capital and reserves part. On the revenue aspect, again, there could only be one thing. Again, this has to align with the disclosure of Schedule 3, both AS and Ind AS disclosure. So whatever is total income as per Ind AS and revenue as per AS is what is to be considered. One issue that could arise is in the P&L, revenue from discontinued operations or income from discontinued operations is shown separately. So should we include that under revenue? Yes. When we say total revenue, your discontinued operations, the result of discontinued operations in terms of revenue is also added to your overall revenue. Now, the critical aspect is on the borrowing. So paid up capital and revenue are still easy to deal with. Why would I say that is very critical? Because if you look at paid up capital and revenue, it's easier to sort of determine. But borrowings is something they say at any time during the financial year. So it is borrowings from banks or financial institutions. 1 crore is the limit, and at any point in time during the financial year. So you're not essentially looking at 31st March. Now that brings us to the question about how do you deal with fluctuating balances? When I say fluctuating balances, daily fluctuating balances, let's say there's an OD limit, or let's say there's a CC balance that is there. Now in that case, yes, the assessment has to be done on a daily basis. You look at, is there any particular day during the financial year where it exceeded 1 crore? If yes, then CARO is applicable. So this has to be done on a day. So then other one is obviously what are included under financial institutions. All the NBFCs are brought under the definition of financial institutions. So all the borrowings from banks and NBFCs are covered there. What about corporate credit card dues? There could be companies which have given credit cards, a corporate credit card to their directors or employees. Yes, corporate credit card dues are also borrowings. So when you're evaluating from the perspective of CARO, you need to factor in the corporate credit card dues as well. Interest accrued and due. Again, there are two things: interest accrued and due and not due. To the extent it is accrued but not due, you need not add it to the borrowings balance. But to the extent it is accrued and it has become due, that has to be added to the borrowings for the purpose of assessment of CARO applicability. What about private limited company being a subsidiary or holding company of a public company? This order very clearly states that for a deemed public company, none of the exemptions that are applicable to private company will apply. So for a deemed public company, it will automatically be covered under CARO. Now, small company versus exempted private companies. If we go back to the applicability, again, it talks about it's not applicable to one-person company and small company. And there's also this exemption given to private companies. What if a company meets the criteria of a small company but not an exempt private company? In that case, CARO is not applicable because both of these are independent. So these are all or. So which means it's a banking company or a small company or a OPC or an exempt private company. So if you're a small company, you need not even worry about exempt private companies. So if you meet the definition, which is, if I'm right, 285 of the Companies Act, you need not worry about determining the exemption status based on the criteria mentioned here. But if you're not a small company or if you're not any of these companies, that is when we would look at the exemption to private companies. Section 8 companies versus Section 25 companies, because the order very clearly says it's only about Section 8. But obviously, if you look at the interpretation of it, Section 8 would include the erstwhile Section 25 companies also formed under the 1956 Act. So CARO doesn't apply to any of these companies. What about applicability to a foreign company? There, ICAI has obviously issued a guidance note on this. There, the guidance is very clear. If the financial statements are to be prepared for a foreign company, then you evaluate if, based on the criteria that is set out, if CARO is applicable. So the key is to determine if the financial statements are prepared. So the Companies Act specifies cases where financial statements are to be prepared. So accordingly, the applicability to foreign company comes in. So then branch auditor, what responsibilities does the branch auditor have in terms of CARO? Again, Companies Act is very clear. Under Section 143, it says that the branch auditor shall have the same responsibilities as the principal auditor. So which means to say the principal auditor, the main entity, the principal entity, if the CARO is applicable, for the component auditor also CARO becomes applicable. Next is applicability to CFS, which is consolidated financial statements. Again, like I've mentioned at the beginning, between 2016 and 2020, all the earlier versions of CARO, 2016 and earlier, you didn't have any clause related to consolidated financial statements. So CARO was not applicable to consolidated audit reports earlier. But with 2020 CARO, you have one specific clause which talks about consolidated financial statements, where as an auditor, as a consolidated auditor, you need to report if there are any qualifications in the separate financial statements of the subsidiaries or joint ventures that are consolidated. So let's say there's a holding company A, which has a subsidiary B, C, D. Now, when you're preparing the standalone financial statements of A, CARO is applicable. When you're preparing the consolidated financial statements of A, you essentially look at if any of the subsidiary separate standalone financials, that is financial statements of B, C, and D, if the auditors have given any CARO qualifications. If they have given, you just report that in the consolidated audit report. So that's the applicability to CFS part. What about non-compliance during the year but rectified before the year end? Again, a very important issue. What if there have been some irregularities in payment of statutory dues during the year, but by 31st March, all of them have been sort of paid? If you look at the text of CARO, it very clearly says they're actually looking at the pattern, how regular they have been. They're not asking you to state facts as it, except one or two clauses. They're not asking you to state facts as it the year end, as it 31st March. They're trying to assess if, let's say, fixed assets, are the records maintained properly? Inventory, are the records maintained properly? Undisputed dues, are they paid out regularly? So it is more about the compliance on an ongoing basis. So if there is a non-compliance during the year, even if it is rectified by the year end, we will still have to report that under CARO. Now, obviously, when we are giving out any unfavorable answers or qualifications, that is when we'll also need to bring out the basis for that. On what basis have we concluded out? So a lot of times it probably helps if you are giving out an unfavorable opinion on CARO, you prepare a table below that, state the reasons and quantify the amounts there itself. So there are also, I think, some questions. I'll take that up before I move to paragraph 5. So in case management in their accounting policies discloses that depreciation has been charged on the basis of useful life and residual values, estimates made by the management, and that this has been relied upon by the Mr. Shiraj, I'm not very clear on that, because if the management has already disclosed it, what exactly is the issue from audit perspective? Can you be a lot more clearer there?
The estimates done by the management, we have not been provided with the appropriate evidence regarding the useful life of the asset. So in that way, we should point it out in the EOM para.
No. It will not be in EOM para, Mr. Shiraz. EOM is only if the management has agreed that these estimates are not correct. You need to look at the useful life. What is the impact of this change in the useful life on your financial statements? So, for example, if the management claims that the useful life of a particular asset is 10 years, and you believe it is not more than 4 years. So now, what is the impact of this on the depreciation and thereby on the P&L and the carrying amount of the asset? If it is material, you treat it as per our modification matrix, but it is not going to be an EOM.
Okay, thank you.
Then in case of a private limited company where CARO is not applicable, in which pro forma audit report is to be given, we need not give the CARO annexure. So usually when we give out CARO, we give as an annexure. So in the body of the audit report itself, under the section report on legal and other matters, one of the sub clauses is about CARO. So if the CARO is applicable, we refer them to annexure A or B or whatever. But if the CARO is not applicable, in the report on other matters itself, in the main audit report of the company itself, which is as per SA 700, in that audit report itself, we say that CARO is not applicable, and hence the annexure is not given, or CARO report is not given. That's to Mr. Virender. Then we have another question. Yeah, great. So we'll move on to the clause by clause or paragraph by paragraph analysis of CARO. Essentially, what I've done is I've given both CARO 2020 as well as 2016, because the audits that we're doing right now, that is for the financial year ended March 20, CARO 2016 is applicable. But for the financial year 21 onwards, you have CARO 2020, which is applicable. But having said that, it is very important for us to evaluate the impact of the clauses of CARO 2020 and communicate to the clients, because there has been a lot of enhanced responsibilities that are included. And like I said, the other good thing because of COVID is the deferment of CARO 2020. Otherwise, we've already finalized our engagement letters, our audit schedules are set out, but CARO 2020 itself would increase your audit effort by at least 30%, if not more. So we look at some of those cases where it would have an additional audit effort. So the first paragraph of the CARO, which is under 2016 as well as 2020, is about fixed assets, erstwhile fixed assets. Now they're calling it PPE and intangible assets. So obviously you have one clause on maintenance of records for fixed assets. Now, if you look at 16 versus 20, fixed assets became PPE, and they've also included one additional thing called as intangible assets, so which was not there earlier. Then we need to talk about physical verification of these by the management. Physical verification of assets by the management. Is it done at reasonable intervals? Then we need to look at if the title deeds are available for all immovable properties. Again, it was there in both this thing. Then two new points got added. One is about revaluation of fixed assets carried out during the year. As a CARO requirement, we need to bring out. I'll just talk about it in the next slide. And the other requirement is about Benami properties. So we have the Benami Transactions Prohibition Act, which was amended in 2017, which if there are any transactions which are, or any proceedings which are initiated under the Act, then that is something which the auditor has to bring out onto CARO. So we'll discuss the implications of these. So obviously key changes being fixed assets to PPE, intangible assets. Now in the immovable properties, while earlier also we had record maintenance and title deeds of immovable property, now the wording has changed. If we look at the wording under the new CARO, it very clearly says, so I'll probably share the CARO order also, so that I think we can discuss that alongside. Yeah. So under the PPE aspect, there, if you look at it, whether the company is maintaining proper records showing full particulars, including quantitative details of PPE. This was there earlier as well. Earlier they were just talking about fixed assets. Now they made it PPE and intangibles separately. The next one is about physical verification and whether any material discrepancies were noted during physical verification. The next one, this is the change that I want to highlight, is about the title deeds of immovable properties. Now they've included the word of all immovable properties, which was not there earlier. And then you have two new clauses on revaluation and on Benami transactions. Now, if you look at these two new clauses, first we'll take up the modification of the clauses, and then I'll come to these two new clauses maybe. I think if you look at the initial clauses, again, how do we define these proper records? This is a problem that we had in the earlier CARO also. When they're saying proper records, what do we mean by proper records, right? So again, there's no definition of proper records. But again, in auditor's judgment, are there records around fixed assets which will give you the description of the asset, the location of the asset, the cost of the asset, and the identification of the asset, which could mean the asset tags? Are all of these maintained correctly? The movements of the assets are tracked correctly? All of these would get covered under proper records. There is no clear-cut definition as far as proper records are concerned. So this is a problem that we have now, and we'll have in 2020 CARO also. Now, one of the other issues is do you consider investment properties or non-current assets held for sale as PPE? Yes, the answer is yes. Though there are separate standards, especially under Ind AS, though there are separate standards dealing with these two types of assets, essentially they are property, plant and equipment. So you will have to consider them for CARO reporting. Now, what do we do with lease assets? Now, as far as lease assets are concerned, the records of lease assets are also to be covered. So when you're reporting on records maintained in relation to PPE, you also need to take into consideration the ROU assets. When I say lease assets, you have a right of use which will come due to application of lease standards. So if under Ind AS, we have all leases are now ROU assets except the short-term leases, right? Under the traditional GAAP, which is accounting standards, all finance leases. So now the finance lease asset or an ROU asset will also be treated, will also be covered here. Then movement of assets, yes, it should form part of your analysis of records. You'll ensure that if the company is saying in the FAR that the asset is located at a particular place, and if it is transferred to another location and that is not captured, that is, you can probably look at how critical that asset is and accordingly take a call on that. Now, so these are all as far as the record maintenance is concerned. The next one is as far as, so the next one is about physical verification. The order also says that we need to evaluate if the management conducts a physical verification. So there are two questions which will arise out of it. What do we do with the discrepancies on physical verification? So if the management has conducted the physical verification and there are discrepancies there, how do we treat it? And the second one is the order says physical verification at reasonable intervals. Again, what do we mean by reasonable intervals? If the management says, no, I'll do it once in 5 years, does that amount to reasonable interval? Obviously, in the order, there's no guidance as such. But if you look at the guidance note issued by ICI, even for the earlier CARO, it says 3 years is the maximum. So that means to say the assets must be physically verified at least once in 3 years, every asset, right? All the material assets. Once in 3 years is the critical aspect. So reasonable interval is again management's call, but it cannot be more than 3 years. It cannot be longer than 3 years. So that is on the reasonable interval. So discrepancies in physical verification versus books of accounts. Again, we need to very clearly identify in the CARO order itself, in the CARO report itself, where any material discrepancies were noticed by the management and how they have dealt with in the books of accounts. So that means to say the management has adjusted them in the books of accounts reasonably, then we're okay. But if there are major discrepancies that have come up during your physical verification exercise, and consequently this is not factored into your books of accounts, your books of accounts are not updated with your deficiencies noted or discrepancies noted, then that is an issue for you to report on. Now, can we apply materiality here? Yes, the answer is yes. Why am I stressing on this point? We'll see when we do the next paragraph on inventory. But as far as fixed assets are concerned, yes, we can look at material discrepancies. So we can apply materiality. And after applying materiality, if you believe the discrepancy between physical verification and what is reported by or what is taken by the management in the books of account is material, that is when we report it under CARO. Then we've spoken about the reasonableness or reasonable intervals. Now, title deeds of lease assets, because there's one subclause which talks about are all the title deeds in the name of the company. Now, essentially, the reason why this is included is, I'm not sure what the situation there in Punjab is, but at least in Karnataka, till about 2 months ago or 3 months ago, we had restrictions on corporate forms of entity owning an agricultural land. But let's say there's a developer who's interested in entering into an agreement with that land or buying that land and apply for a change of land use. Now, till that land use is not changed or converted, till that point in time, this land will be held in the name of a nominee. So that these are the transactions that you'll have to be very wary of, and you'll have to report very clearly. So the wording of the order is, are all the title deeds of all the immovable properties in favor of the company. So which means to say your registration documents are all in favor of the company. If no, then we have to again give a detailed description of the nature of the asset, where is it situated, what's the value of the asset, in whose favor it is, why is it that it is held in someone else's name, and your remarks accordingly. So that's on the title deed. But title deed of lease assets is not required. While I said lease assets, you need to factor in for your overall applicability of this paragraph. But for the applicability from a title deed reporting point of view, lease assets are excluded. So that's specifically mentioned in the order itself. Now, two new clauses or sub-clauses. One is on revaluation and one is on Benami properties. Now, first we'll take up the revaluation part of it. So first, again, at the outset, I want to clarify this. This revaluation is only applicable if the company is following the revaluation model and not the cost model. So if the company is following the cost model, there can only be an impairment on account of downward revaluation, right? There can't be an upward revaluation. That's for cost model. But by chance, if the company is following a revaluation model, that is when this becomes critical. So this is sort of inserted to ensure that companies are not artificially inflating the value of the assets. So you need to report on if there have been any revaluations, and if there have been any revaluations, we need to look at what is the basis for such revaluation. Has there been a report of registered value? So, or is it just that the company believes on their estimate they have revalued it? If that is the case, then we have a problem. And any amount of change in excess of 10% has to be reported. Now, 10% for each class of assets. So within your entire PPE schedule, for each class of the assets that are therein, if the revaluation is more than 10%, then you have to report, and both are separate. Even if there is a registered value or report which is obtained, and then the revaluation amount or the change is more than 10%, you report that. Or there's no registered value or report that is obtained, and then also you report it under the revaluation clause. Benami property, this thing that I've already mentioned, again, a new clause which is inserted under the new CARO, which these two are not applicable for 2016, which means that when we're doing the audit for FY20, we don't have to worry about these two, but for 21 onwards, obviously we have to factor this in. So Benami property, if there are transactions, if there are proceedings which are initiated under the prohibition, Benami Transaction Prohibition Act, that's something that we'll have to disclose here. Now, does this mean we've already had one clause where we are reporting on title deeds which are not in favor of the company? No, not all assets. It is only where the proceedings are initiated. If the proceedings are initiated, that is what you'll have to report under the Benami property clause. If the title deeds are not in the company's name, for whatever reason it could be, that you would have to report under clause C, which is title deed of immovable property. So that's on PP and intangible. Now this is something, again, there's a big change here as far as inventory is concerned. The second paragraph of CARO deals with inventory. So obviously 2016 also we had the same physical verification of inventory, but there's a significant change there. Now what are the key changes? You also report on coverage and procedure of physical verification carried on by the management. So earlier we were reporting on if the records are maintained correctly and if the physical verification of inventory is performed by the management. Now, if you look at 2020, we are reporting on the coverage of the physical verification exercise of the management, the procedure that the management has adapted to carry out the physical verification, and then we need to give out our opinion saying is it appropriate. But having said that, this is something that we would have anyway done during our audit of inventory. So to get a comfort on our inventory balance, we would have anyway verified if the physical verification activity. So wherever it is practicable, obviously we would have been there for observing the physical verification procedure. So the management would have done the physical verification, and as auditors, we would have gone there to observe the physical verification activity, right? So as part of getting comfort on the inventory cycle, we would have anyway done this, but now we have to report in CARO also. And for whatever reason you believe, it could be the coverage not adequate, or the procedure that they've used to perform the physical verification is not appropriate, you would have to bring it out onto CARO. Now, what can be the instances? What is it that we need to check? We need to check how the management has given instructions to its staff relating to physical verification, what kind of staff has been employed for physical verification, how have they dealt with the differences, how have they dealt with the control lapses. So that is what we need to assess here, and if any of that is not appropriate, we need to bring in here. And this is where we have to be careful. Under the earlier CARO, it says if the material discrepancies are identified and not adjusted by the management in the books of accounts, that is what you'll have to report. But here, that word material discrepancy is replaced with discrepancies of 10% or more in the aggregate of each class of inventory, which means to say, this is why I said in fixed assets, you still have materiality. But for inventory reporting under CARO, we need to be absolutely careful. It can so happen that, I'll give you a hypothetical example. Your overall materiality limit is, let's say, about 10 lakh, and your tolerable listing is about 6 lakh. Now, the management has done a physical verification of raw materials. Now, during that physical verification of raw materials, now, let's say the value of raw materials itself is about, in the books of account, is, let's say, is about 1 lakh. Now, during that physical verification, they were able to trace out assets only of about 80,000. So then there's a difference of 20,000 in that. But if you technically look at this clause, it says discrepancies of 10% or more in the aggregate of each class of inventory. That means to say I'm comparing 80,000 with 1 lakh, and there's a discrepancy, right? So, and which is more than 10%. So the word material discrepancy has been replaced with a quantitative definition, which says 10% or more of the class. So that means if raw materials which are hardly a lakh, and there's a 10%, you still need to report it under CARO. So we need to be very careful here. Our audit materiality and this are totally different. Here we cannot apply audit materiality because the order itself has very clearly defined the quantitative threshold. So 10% of each class. However, it can so happen that within raw materials there are compensating differences. Then you look at an aggregate for each class. That means to say raw material A, there's a difference which is in one direction. Raw material B, there's a difference which is in other direction which will compensate off. Then we need to look at an aggregate level what is the difference and compare that with what is the amount in the books of account. 10% or more, we have to report it, otherwise we're fine. So that's on the material description. Third point is something which, again, it's like outsourcing of someone else's responsibilities onto the auditors. So where they're talking about quarterly stock statements. And now, as an auditor, we now have to report in CARO if the quarterly stock statement submitted by the client to their bankers is in line with the books of accounts. A completely new reporting requirement, and this is why I said clauses like this you'll have to communicate with your clients right away and not wait for the end of the year, because a lot of times we see that the stock statements are prepared by the management and sent out to the bankers. Now, at the end of the year, we obviously do an inventory check, but periodic stock statements, are we really placing that much emphasis on? If we are not, then this becomes critical this year, where we'll have to look at, so all cases where if the working capital limit availed by the client is more than 5 crore. And again, we're looking at the sanction amount. It is not the drawn down amount, it's not the disbursed amount. At a sanction level, if the limit is 5 crore or more, that is when it is in excess of 5 crores rather, sorry. And then that is when this clause gets attracted. And in all such cases, you essentially look at what are the quarterly submissions to the bank. Are the quarterly submissions in line with the books? If they are not, then you have to bring out onto your CARO report itself. So again, I think some of the issues that will come around because of these changes. Now, what do we mean by appropriate coverage and procedure? Again, we are looking at, like I gave you examples, we are looking at what sort of instructions have they given, how are they dealing with control lapses, how are they dealing with differences. So all of that would cover under appropriate coverage and procedure of physical verification. Reasonable intervals, like we had this issue in case of PPE, we also have this in case of inventory. Now, what do we mean by reasonable intervals? Again, in case of inventory, there's no hard and fast rule anywhere, but the guidance note says that in case of inventory, the management should at least physically verify all material inventory items at least once a year. So in fixed assets, I said once in every 3 years, but in inventory, it is once a year. So at least once a year, all the material inventory items must be physically verified by the management. So that's how we define reasonable intervals. Now, discrepancies over 10%, obviously report if adequately dealt in the books of accounts. I've already mentioned this. Materiality relevant? No, materiality is not relevant. Audit materiality. Any discrepancy over 10% has to be reported. But we can sort of factor in the compensating differences and report on a net basis. Working capital limit, yeah. Will you include the non-fund based limit? Yes, because the word that's used is the total limit of in excess of 5 crore. Now, fund, non-fund, obviously they would have factored in what your current assets is before the limit is fixed, right? And that includes the non-fund limit as well. And hence, when you're looking at the limit, it is the total limit that is important and not the fund versus non-fund limit. Sanction limit is relevant and not the actual utilization or drawn down. Again, this limit of 5 crore is at any time during the year. So it could so happen that the company has availed a working capital facility during the year, but by 31st March, the facility is closed. Even then, this clause is applicable. So obviously, we'll need to verify if the quarterly returns are in line with the books. The next one is what if the returns are filed monthly? So there could be some banks where the client is sending the statements on a monthly basis. In that case, how would we deal with it? Again, the order is very clear. As an auditor, our responsibility is to audit it on a quarterly basis. So even if it's going every month, we'll have to pick up June, September, December, March. So that's the quarterly return that is submitted. So to that extent, we have a relaxation there. So yeah, so I think this is a key change as far as inventory is concerned, the stock statements aspect of it, because there are already enough checks within the banking system itself where ideally, if in an ideal world, there is a review and monitoring mechanism within the bank staff Then there are stock audits which are conducted by the bank through an empanel fee or otherwise. And then there's an added layer. So now they're bringing the statutory auditor of the company also into this. So in a way, there's a third or fourth layer that they're bringing in, saying the statutory auditor also will have to certify what is submitted through an indirect inclusion in Caro. So brace up for it. And obviously the other thing being the material discrepancy of 10% or more in the value of inventory. That material is being replaced by 10% now. So before I move on to loans, investments, and guarantee, there are a couple of questions, I think. So physical verification is done by authorized person and not by the management themselves. Is there any guidelines regarding person designation that he should not be below that rank? Quarterly stock statement should be the responsibility should be of the internal auditors. Yes. So I'll deal it in two parts. So the first part is if it is done by an authorized person and if the management has authorized that person, as an auditor, we need to evaluate if that authorized person is qualified enough to understand what he's doing. As long as that is happening, we are okay. So it's about who they have appointed as authorized person. But if you believe as an auditor, you have enough evidence to believe that that authorized person is not technically capable of carrying out the inventory, then you are free to do your own procedures, including questioning the valuation of inventory. So it's about who that authorized person is that is critical, Mr. Chaitanya. Then we have quarterly stock statement should be the responsibility. Yes, sir. I mean, like I said, ideally, as a statutory auditor at the end of the year, I shouldn't be reporting on this, but I think, like I said, that expectation gap versus what we are reporting, I think. So that is why they've included the statutory auditor also into that. So in addition to the bank staff, in addition to the stock auditor appointed by the bank, now we are also drawn into the whole thing. Probably why not internal auditor is because not all companies have internal audit. So if you look at companies like 2013, the thresholds are fairly high. So mandatory appointment of internal auditor. So that's probably one of the reasons why they've brought it into the Caro and not internal auditor. So that's on inventory and fixed assets. So the next paragraph deals with loans, investments, and guarantees. Again, a lot of changes in this. Earlier, it was restricted to investments, provided guarantee, or loans or advances. Now, so predominantly to related parties, the earlier version of Caro. But if you look at now, it talks about all parties. So if you look at the first subclause, clause A, where we need to give out what are the total loans, investments, and guarantees that are given during the year to subsidiaries, associates, joint ventures separately, and to other parties separately. So earlier we were restricting to only related parties. And then the other clauses being, are they prejudicial to the interest of the company? Then you need to report, is the repayment schedule there? Is there any overdue amount? Those are all continuing. In addition to that, two new subclauses are added. One is on renewal or extension of such loans. And second is, how do we treat loans repayable on demand? So these two are the new clauses that are added in 2020. So obviously, yeah, like I mentioned, scope widened to include all loans under 186 and not just 189, which is dealing with related parties. So 186 is all loans, investments, and guarantees by the company. So investments and guarantees included now. Now, evergreening of loans is something that they're trying to tackle. When I say evergreening of loans, they've added a clause here which talks about renewal or extension of facilities. If they've renewed something just to ensure that it doesn't get reported under overdue amount, that is something that we'll have to report it here. So that's evergreening of loans. Then loans repayable on demand, again, there's a separate reporting requirement there. Now, are there any exemptions given? Because if you look at it, if you're auditing an NBFC, are there any exemptions given with respect to reporting under this clause? Exemption is given only with respect to clause A and E. Again, logically, I don't understand why they had given exemption with respect to E, because evergreening of loans is a major problem with NBFCs itself. But again, they've given an exemption there. And they've also given an exemption with respect to reporting under clause A. So if the principal business of the company is to give out loans, then they have exemptions from clause A and clause E. But for other companies, all the clauses are applicable. So obviously, what is the disclosure that is required? Under clause A, we need to disclose the aggregate amount of loans given. Again, we need to give out to group entities separately, to non-related parties separately. Now, when I'm talking about the aggregate, we are also looking at the gross amount. So it is so possible that you've given a loan of 50 lakh to one of your subsidiary entities, and by the end of the year, 20 lakh is repaid. So outstanding amount is 30 lakh. In this clause, you report 50 lakh, which is the gross amount that was given out. And this reporting has to be done for group entities separately and the other parties separately. Then, yeah, we need to be very careful with loan versus advance classification, because if you believe it's an advance in the normal course of business, then there's another clause which deals with it, which deals with related party transactions. But if it is an advance, it specifically comes here. Now, how do we determine loan versus advance? Again, the determination could be on the basis of the quantum of advance given. If it is a usual business practice to give that amount of advance to any arm's length at any arm's length transaction to an unrelated party, then you can treat it as an advance. But if there is an inherent top-up element involved, what do you mean by inherent top-up element? If I'm buying the same asset or the same goods from an unrelated party, I give an advance of let's say 100, but because it is my subsidiary, I've given an advance of 150. That additional 50 is a loan essentially. So we need to do that comparison. And the moment it is a loan, that gets covered here. If it is an advance, it gets covered under related party transaction. Then the auditor will have to ensure compliance with all the Companies Act related provisions with respect to loans, the cap with respect to what is the maximum amount of loans given, the restrictions placed thereon. That is something that we need to be careful of. And then they've also included guarantee here. Now, this is a very tricky thing to audit because unlike your loans and advances, it doesn't come on to the books, right? It's a contingent liability. But the reporting requirement is very clear that you'll have to report on all guarantees. So we need to be absolutely careful. So we need to probably look at the controls around guarantee. We'll need to review all the loan documentation around this to identify if any guarantee has been given. So this is guaranteed. Typically, again, the risk will emanate from loan taken by the director and the company has given a guarantee. Loan taken by a subsidiary company, the company has given a guarantee. So we need to be very careful there. Now, how do we determine if any loan, investment or guarantee given is prejudicial to the interest? Again, review of terms and conditions. One critical thing is what is the interest that you are charging along with the regular yield rate. If there's a huge difference there, then you might want to conclude that it is prejudicial. You look at other terms and conditions like the security taken. Can this loan be given to an unrelated party without security? But here, if you say the answer is no there, but here you're given without security, then you will have to conclude that it is prejudicial. So you need to review the terms and conditions. You need to look at the company's financial standing and the borrower's financial standing as well. Then report on regularity of payment and payment of interest. Obviously, that is something that was there earlier. So earlier also you have that repayment part coming in, and now again you have that repayment schedule which comes in, where you need to talk about how regular the company has been with respect to payment of interest or repayment of dues, and any overdue amounts more than 90 days are to be reported. Now, what if there had been an overdue during the year but it is sort of paid off by the end of the year? Again, you'll have to report it. Like we said, the issue is Caro wants to deal with the regularity of it. It is not about what is it as of 31st March. It is the regularity aspect of it. Hence, during the year, if something remained overdue for more than 90 days, you report it saying there has been a delay of more than 90 days, but now it is sort of paid. So that reporting is required. And unfortunately, there's one more thing that is attached to overdue amount. The order also wants us to report if the management has taken adequate steps with respect to recovery of these dues. Now, again, a very tricky area to audit. Should we go only by legal proceedings? Practically speaking, that's not possible. It is not always that the moment there's an overdue amount, the company starts sending out legal notices, not necessarily so. So you again look at what is the business practice and you evaluate if the company has actually followed up. But if by any reason you believe what they should have done in terms of follow-up and they've not done, then you'll have to report it here. Now, this is very critical because essentially, if you look at it, the exemption is not given to NBFCs also. So this applies even to the loans given by an NBFCs and how by an NBFC and how they are following up. So if the follow-up is deemed to be inadequate, then you'll have to report it here. Reporting on evergreening, again, like obviously, I'm sure all of you, when you do bank audits, you would factor this in as well. Same thing from a company perspective right now. Is there any loan that the company has given and just because it's becoming overdue, they're renewing the limits and renewing the loan? So that if that is happening, then we'll need to report it, but not applicable in case of NBFCs. Again, loan repayable on demand. The order very clearly says we need to report if there are any loans repayable on demand, which are given to directors and related parties. That's one disclosure, and to others also separately. So there's no materiality here. There's nothing with respect to a quantitative threshold here. So the moment you give a loan to a director, which is repayable on demand, it has to be disclosed under this particular paragraph. Now, some questions around fixed assets, I'll take that up before I move further. Sometimes new machines are purchased but not found of use. How will it be dealt? Okay. Non-fund based limits are not found with the management. Your suggestion in this regard? Yes. So first question, when new machines are purchased but found not of use, How will it be dealt? Again, we need to apply our standard on impairment of assets. That is one standard that you could probably apply. You compare what is the carrying amount in your books versus what's the value in use. Now, when I say value in use, again, you're looking at two things. So value in use, you look at, can I sell this asset and get something out of it? That is the fair value. Second is, can I generate some cash flows by using that asset? So if we can do either of this, the higher of that is to be taken. That is, by selling the asset, I get X, or by using in the company, I generate cash flows of Y. The higher of X or Y we take, let's say Y is higher, we compare Y with the carrying amount of that asset. And if by chance the carrying amount is higher, we'll have to impair that. But if the value that you'll get from the asset or the sale value of the asset is still higher, we are okay. We can continue to show it at cost. But if any of these values are higher, then you'll have to bring that down. The carrying cost has to come down. That's the question on carrying amount of the asset. Now, non-fund based limit details are not found with the management. Absolutely, sir. So non-fund based limit details. So that is where I think the probably top of my mind, what I can think of is we'll need to review the sanction letters very clearly, because the sanction letters usually evidence, and we're not looking at the availment of that. We're only looking at the sanctioned amounts, right? So we'll probably have to review the sanction letters and the documents, documentation around that, term sheets or sanction letters by whatever name called, and that is probably the source through which we can identify the non-fund based limits. Yeah, so that's on loans, investment, and guarantee. The next clause is again related to this one, loans, investments, and guarantee. The earlier CARO had one specific paragraph for transactions, loans with related parties, and again, it's the next paragraph also is in relation to that, but this specifically deals with loans to directors and companies or entities in which directors are interested, while the earlier one spoke about joint ventures, subsidiaries, and associates. Now, the same clause is retained in CARO 2020 also. There's been no change as far as that. So again, we look at loans to directors or entities in which directors are interested. These could be, so obviously these are not direct subsidiaries, but these are entities in which directors are interested. Now, how do we get this information? We'll need to review the disclosure of interest by directors given under MBP 1. That will be a source to audit this. Then again, loans and investments by the company, very similar to the 186 provision that we've seen earlier. You need to be very careful with what are the limits. Has the company breached any of those limits? If yes, then again, you'll have to report it here, because the order says you need to report on if the sections of the Companies Act have been complied with. And if there is any non-compliance whatsoever, it could be a breach of the limit, or a special resolution is required, but the special resolution is not passed, or if a member's approval is required, that member's approval is not obtained, any non-compliance whatsoever has to be reported in CARO under this clause. And again, the other thing that we need to be careful is it prohibits more than 2 layers of investment. There's a restriction coming in from section 186 that we'll have to be careful. The aggregate amount of loans and investments cannot exceed 60% of the capital and reserves. That is something that we need to keep in mind. Should we consider the restrictive covenants imposed by the existing lenders? That is where there's an existing term loan with a bank, and the bank said, before you make investments, you need to take my prior approval. Should we consider that restrictive covenant while applying this? The answer would have been no, except for the fact that if you look at section 186 right now, the way it is, it says that one of the restrictions is either you look at if you're within the limit, the 60% of capital and reserves limit. Second, obviously, there are other restrictions like who can authorize and all of that. There's also one more important condition which is specified in 186. That says if there is any loan from a bank or financial institution, if there is an existing loan from a bank or financial institution, before you make any new investment or loan, you must also take the approval of that banker. So that is something, that is critical. So the auditor has to evaluate it. And if the approval is not sought and obtained, then again, we'll have to report it under CARO. So obviously you'll have to report all the non-compliance along with the maximum amount outstanding during the year, as well as the amount outstanding at the end of the year. So that's with related party loans. Deposits, again, more or less the same clause is retained. It's just that they've added deemed deposits into this particular paragraph. Earlier it dealt only with deposits. Now deemed deposits, again, deemed deposits is again the same thing that we've seen in the company's acceptance of deposit rules, where you have share application money received, but within 60 days you've not allotted shares, or you have an advance for purchase or sale of goods, but you've not actually knocked that off or settled that off. So in case it it is not allotted or not knocked off, it becomes a deemed deposit. So the same definition will continue here. So we need to report on deposits and deemed deposits. Again, the source from a statutory auditor point of view is, again, we need to review the DPD3 which is filed. And if there is any other non-compliance with section 73 to 76, that gets reported under deposits under or deemed deposits. Cost records, again, there has not been any change in this. The same paragraph is retained as it is, 2016 as well as 2020. So we first need to ascertain if it is applicable on the company. Are there cost records specified by the central government? Obviously, the central government has notified some specific industries which are required to maintain these cost records. So we need to identify some specific manufacturing industries. So we need to identify if the company falls under those. If yes, then we need to report on whatever records are supposed to be maintained, have they maintained it? And if a cost audit is applicable on the company, then again, it's important that we look at the cost audit report as well. So obtain the cost audit report, look at if there are any adverse remarks by the cost auditor, which are critical for your reporting under CARO. That's the other thing. Yeah, this is again a very important reporting under CARO, which deals with disputed dues and undisputed dues. So obviously, in terms of the language change of the order, there's only one change. They've included GST into the order. So where they're talking about income tax, sales tax, VAT, etc., they've brought in GST also. Other than that, it's the same clauses that are retained in 2020 CARO as well. Again, here it's the regularity in payments that are to be reported. Undisputed dues for more than 6 months to be reported. So two things. These are two separate aspects. So a lot of times we look at by the balance sheet date, if there's nothing outstanding for more than 6 months, we can safely conclude that there's no adverse remark under this clause, but that is not the case. Essentially, this clause asks the auditors to evaluate two aspects. One is the regularity in payment, and second is there anything outstanding as at the year end? So what do I mean by the regularity of payments? You essentially look at during the year, has there been any significant delay in payment, even if that payment is made before the balance sheet date. So that is the regularity aspect. Second is the undisputed dues outstanding for more than 6 months. So irrespective of your conclusion or regularity or irregularity, if there is something that is outstanding for more than 6 months, then you'll have to report that as well. So you could technically have a situation where there is no undisputed due for more than 6 months as at the end of the year. However, the regularity is not met. So which means to say, hypothetical example, let's say TDS dues for the month of April, which should have been paid by 7th of May, they've not paid it till the month of December. But in December, they've made good all the payable, and by the time they came to March, it was all regular. Now, what about reporting under this clause? Obviously, there will not be any undisputed dues outstanding for more than 6 months. That we are fine. But the regularities in payment, you have to mention that the company, there has been an irregularity involved, and you have to bring that out. A lot of times, we used to take a very, diplomatic approach is not right as far as audit reports are concerned. But here, unfortunately, the guidance note also lets us use the word generally been regular or generally not been regular. So again, it's the auditor's judgment as to how you would define what is general, what is not general. But simple benchmark rule of thumb there would be, if there are repetitive delays, month-on-month repetitive delays, you cannot say generally been regular. You have to say they have been irregular. If it is a one-off case, that is when you say that they have generally been regular. So please do bear that in mind. There are two reporting considerations here, regularity and outstanding for more than 6 months. Now, are only state and central taxes covered? What about the property taxes that I pay? Those are also covered here, because the order very clearly says state, central taxes, or any other tax, including the local statute, right, or payable under any statute. So those are all covered. What is excluded here is payment on account of contractual obligation. Let's say there's an employee benefit expense that is payable, let's say salary payable or incentive payable. Those are all contractual obligations. So those need not be reported here. But any non-contractual obligation which is arising on account of a statutory due, that has to be reported here. Reporting of regularities irrespective of amount outstanding. It doesn't matter what is the amount outstanding. If there's a delay, even if the PF use, let's say the materiality threshold of the company is, let's say again 10 lakhs, there has been a delay of payment of PF of 2,000 rupees for 10 months. Unfortunately, we still have to report it, because here there's no materiality and there cannot be any materiality also. So now the reporting is slightly different for disputed use and undisputed use. Now, how do we make the distinction between the two? Very critical, because in case of disputed use, you have to mention all details of disputed use. In case of undisputed use, you only have to mention if they're outstanding for more than 6 months or if they have been regular. Now, again, a matter of dispute is only when the company has taken a positive action. So that is, example would be filing an appeal. Mere representation is not a dispute. So that is where you just written a letter is not a dispute. You acted as per the respective acts. Whatever is the forum for challenging the order of the department, you've acted as per that, and you've taken a positive step there. It could be filing of an appeal or going to a higher authority or whatever. Only that can be construed as a dispute. Mere representation by the SEC cannot be construed as a dispute. Should you include interest and penalty as amounts payable? Yes. Interest and penalty are also to be considered while you're disclosing the total amounts payable. Again, reporting on regularity is not required for each instance. For example, if you report, it is enough if you're saying that generally the deposits have been enough. You're not required to maintain. So let's say you're not required to maintain it on a month-on-month. So as long as you're saying that usually or generally the company has been regular in depositing of TDS dues, that is fine. Then all disputed dues are to be reported. Again, no materiality involved in this clause. Irrespective of the amount involved, we have to report it. And in case of disputed dues, you have to report it for each dispute. For example, assessment year 16-17, there's a dispute there, and then there's an assessment year 18-19, there's a dispute. You need to report the two. So that is something that we need to be very careful. In some states, companies are treated non-state subject and as such not permitted to purchase land. In that case, property is purchased out of fund of the company. Yes, sir, Mr. Virender. Yeah, in that case, what we'll have to do is there is a clause in our paragraph 1 where which deals with all title deeds in favor of the company. So in that case, you have to mention. Is it clear now? So yes, so I was saying if there is any property which is not in the name of the company, but property belongs to the company, the title deed is in the favor of a particular director, then we need to very clearly mention in the clause in paragraph 1, where we're talking about all property deeds available, we need to give out a table property wise in whose name is written and why is that so. So whatever you mentioned, sir, because for whatever restrictions imposed by state, they cannot buy it, you need to mention that reason, including the amount involved. What is the cost that is getting carried in the book? So it's not a qualification, but it's a bringing out of information onto the CARO report. Yeah, so that's a disputed and undisputed dues. I was saying it has to be done for each dispute. So for income tax, it's probably for each assessment year. Then unrecorded income, again, a new paragraph that has been brought in. There was no such reference in the earlier orders. So in the new order, CARO 2020, we have one specific paragraph which says, if you have disclosed any hitherto unrecorded income to your income tax authorities or surrendered any income to income tax authorities, the auditor needs to see the impact of that onto the books of accounts. And accordingly, you'll have to disclose it in CARO. So this is only applicable when transactions were earlier not recorded in the books of accounts, but during the year, they've been surrendered or disclosed as income to the income tax authorities. So again, the emphasis is not on prior period errors. If the management identifies something to be a prior period error and adjusting it in the books, we are not talking about that. We are specifically talking about unrecorded income, which is now disclosed to the income tax authorities. So if you have surrendered something to the income tax authorities or disclosed to the income tax authorities, then you need to review that and see if that is adequately covered under the books of accounts. And what do I mean by adequately covered? It is not just enough if you're just directly taking it into the revenue. We need to look at the impact on, let's say, AS5, prior period items. Are you dealing them accordingly? Have you given a note in the financial statements? So that is what, as an auditor, you need to report on. If that note in the financial statements is not there, then you'll have to report that under CARO very clearly. So obviously, proper recording includes disclosure in financials. If there's no disclosure in financials, you're free to report it under CARO. Loans and borrowings, again, this is where you have taken loans. The earlier paragraph that you've spoken about, there we discussed about where the company has given out loans. So here it's about the company availing loan. Again, if you can very clearly see that earlier we were only reporting if there is any default. But now there are a lot of other subclauses included, including one about willful defaulters. Has there been any diversion of funds, short-term funds used for long-term purposes? Again, if if we go back to the context of how we began all of this IL&FS and many other scams that have taken place, the government wants to also fix our responsibility towards that, and they want us to explicitly report on some of these matters. So short-term funds used for long-term purposes, if you have taken any loans on behalf of subsidiaries, associates, and joint ventures, if there is any pledge. So let's say you hold shares in your subsidiary, you've taken those shares in the subsidiary and given that as a pledge to one of the bankers and availed loans. So those are the transactions that we need to report here. And again, the coverage is any lender. It doesn't only talk about financial institutions, banks, governments, or that was what was defined under the earlier earlier order. But in 2020, it talks about any lender. So which means to say all types of loans are getting covered. Again, they very clearly prescribe the format for reporting as far as Order 2020 is concerned. Then there are also new clauses added. Now let's look at some of those new clauses added. One is with respect to willful defaulter, where there has been a pronouncement by the banks in accordance with the provisions of RBI as willful defaulter. That is something that we need to report. Application of funds, short-term to long-term. I'll discuss each of these. But first and foremost, borrowings for reporting under this clause do not include public deposit. Why is that so? We've already covered deposits under another clause in CARO. So you don't have to factor in deposits here. So these are borrowings other than those covered as deposits or deemed deposits. Again, like we've seen in case of loans given, even for loans availed, defaults during the year to be reported, not just what is the unpaid amount as at the balance sheet date. So even during the year, if there have been any defaults, you need to factor that in. Pending restructuring proposals, how do we do it? We've made an application for restructuring. Should we consider that as a default? Until and unless the proposal is accepted, it will have to be considered as a default. So it is only when the proposal is accepted that you can treat it as a restructuring of loan. So during the interim period, where even if you have made the application and that application has not been approved, it will continue to be a default. Now, the new reporting requirement with respect to a willful defaulter, again, we need to look at the declaration by bank or financial institution as on the balance sheet date, as well as on the date of audit report, because it can so happen that on the balance sheet date, it was fine, but while you're signing the audit report, by that time, the company has been declared as a willful defaulter. Then you'll again have to bring that onto the CARO report. This is very critical. Application of funds. Have you applied the funds for the purpose borrowed? So there are two things as far as application is concerned. One is, are you applying it for the funds borrowed? Obviously, if there are specific borrowings, it's slightly easier. But again, having said that, money is fungible, right? You can't say that I've used this money towards that or that money, because it'll all come into a common pool. Usually most companies have 2 or 3 bank accounts where all the monies will come in, and from there it will get dispersed. So establishment of one-on-one correlation will be very tricky, very critical. So please be careful while applying audit procedures under this clause. So again, specific borrowing is relatively easy. General borrowings, you'll probably want to take a look at the RBI guidelines here, where they spoke about some instances. They've given examples of instances which can be treated as diversion of funds, where without prior approval, they've invested in subsidiaries, or they've sort of routed the funds to one of the directors in related parties. So all of these are to be treated as diversion of funds in case of general approval. So RBI has given these guidelines, so we can probably go by those RBI directions. What about, let's say I've taken a loan for the purpose of construction of an asset, and during the construction phase, I've invested this loan elsewhere and I started earning interest out of it. Will it be treated as diversion of funds? The answer is no. If you have done it only for the interim period, it will not be treated as a diversion during the construction period. Now this short-term to long-term purpose is again very critical. Why is that brought in? Again, to look at the liquidity position. The order wants the auditors to also look at the liquidity position of the company. So where short-term funds have been used for long-term purposes, it can so happen that you'll not be in a position to meet your obligation, short-term obligation. So that is why you need to report that. So again, the difference between long-term funds and long-term assets is what you can use as a benchmark. Otherwise, there's no formula to calculate this. So probably you look at, as on the balance sheet date, we look at what is the total long-term funds that are there on the asset side, long-term assets versus long-term funds. And then if long-term assets are higher than that, then we have a problem. Then we say that maybe something out of your current liabilities or short-term borrowings are used towards long-term assets. So that is the evaluation here. Current asset is also an indicator. Current assets of less than 1 could also indicate that you've diverted some portion of your current liabilities towards your long-term assets. How do we treat current maturities on long-term debt? Because strictly speaking, as per the classification of it, any current maturity on long-term debt is obviously classified under current liabilities. For the purpose of evaluation of utilization, you can treat it as a long-term fund. So otherwise, obviously, the entire thing will be skewed, right? Because you're including current maturity on long-term debt under current liability. And then when you calculate your current ratio, it will skew the whole thing. So that is why it is allowed to take the current maturity as a long-term debt. One of the other criteria is to look at loans and account of subsidiary. Is it that you've taken a loan in the ordinary course of business, or is it a loan taken on behalf of the subsidiary? Again, we need to critically evaluate the cash flows of subsidiaries also to see that if there is any shortfall there, to fund that shortfall if you've taken a loan, that is what will get covered under this. Again, all loans taken during the year are to be reported. It is not only the loans which exist as on the balance sheet date. So all loans taken during the year are to be reported here. The next clause, again, a very simple this thing. Again, there are a couple of questions. I'll take it up. So again, sir, in terms of the reports that are not shared with us, it could be investigative reports or transaction reports. Again, see if it will amount to a restriction of your duties. So in the sense that, is it something that you need to evaluate and there are restrictions imposed? If yes, then we can go back to our discussion on SA 705, where they're not giving you access to evidence. So treat it accordingly. If it is a material thing related to one cycle, it will be a qualification. But more than one cycle, you might want to give a disclaimer on opinion. 3.3 is not applicable to companies principal if lending is one of the major activities, but not principal business. No, 3.3 again, it's not a blanket exemption given, Mr. Kishore. If you look at 3.3 also, there are only two subclauses that are given where the principal business is to give loan. It is only the clause which talks about giving the overall bifurcation between loans given to related party and loans given to others. That is exempted. And the other exemption that is given is with respect to evergreening of loans. Other than these two, even companies which have principal business of giving loans, all of those companies will have to comply with provisions of paragraph 3.3. Now, if lending is one of the major activity, but so here we again go by the RBI rules here, because I'll take it up in one of the subsequent paragraphs. We need to be very careful if more than X percentage of your financial assets, or percentage of your total assets are financial assets, or more than X percentage of your income is from financial assets, then will be covered under the RBI guidelines. And if you're getting covered under the RBI guidelines, automatically you'll be called a financial institution. We use that definition to evaluate if exemption under 3.3 will be available. So that I'll take it up. Again, this is a fairly simple thing applicable in case of listed companies and in case of preferential allotment. I'll quickly cover, we're running short of time. So in case of IPOs and FPOs, you look at if the utilization is towards the purpose the funds are raised. Again, where do we get this utilization purpose? We again need to review the offer documents. We'll get the utilization purposes and then compare it with the end use. Now, preferential allotment and private placement is what is applicable for all types of entities. If you look at probably IPO, FPO, it's only for larger listed entities. But if you look at private placement or preferential allotment, if you look at the way Companies Act is now, that we'll have to comply with all of these regulations. So again, as an auditor, Section 42 and Section 62, which deals with preferential allotment and private placement, you need to have a look at that. You need to ensure that all the conditions specified that are met. Conditions include, for example, are you taking members' approval correctly? Are you allotting within 60 days? Have you opened a separate bank account into which the share application money is coming and is kept till the allotment is done? We need to look at all of that. We need to look at the filings, including the PAT forms that we file with ROC. This is again a reporting that was there earlier, but now enhanced fraud reporting. If there have been any frauds perpetrated on the company or by the company, we had to report. This was what was there earlier. Now the scope is slightly widened. Earlier it was frauds by the company or on the company by its employees or directors. But now that is changed. They've removed that officers or employee. Officers would mean all the as per the Companies Act, director, secretary, etc. So now they've removed that officers or employees, which means to say any fraud whatsoever by the company or on the company is to be reported here. Interestingly, what they've also added is they're talking about something that you have reported under ADT 4. So they want you also to declare that whatever reporting is there as per ADT4 requirement to report to the central government, that is complied with. And there's one more thing that they've added. Have you reviewed the whistleblower complaint? But as of now, there's a slide listing there. Whistleblower compliance as a policy is required to be maintained only by listed companies, if you look at the Companies Act. So considering that, for unlisted companies, again, if there's a policy which has been put in place by the company, you can look at it. If there's no formal policy by the company, you can state that. But the larger issue is, if there is anything noticed and reported, that is what will come under CARO. But if there is something that as an auditor you have identified, but something that is not noticed and reported by the management, then we have to report it. We have to still report it under ADT4. But reporting under CARO is only for what is reported and what is noticed and reported already. Then again, when you're looking at fraud assessment, to critical assets, has there been any misappropriation of assets? And second would be, is there any fraudulent financial reporting? So for which again our sources of information could be review internal audit reports, whistleblower complaints, then income declared voluntarily can also be something that we'll want to look at. Then all whistleblower complaints during the year are to be considered. Needy companies, I'll quickly skip this. Then yeah, related party transactions. Again, we've discussed at length with respect to the loans given, loans received. This is with respect to the overall related party transactions. So again, we need to ensure compliance with 188 and 177, and as well as disclosure under the respective accounting standards. So AS 18 or 24, whatever the case may be in the AS 24. So again, compliance with the Companies Act, you look at the approval by the board or members. You look at if any of the conditions have been breached, entries into the related party register. See if any of these are given in the ordinary course. If something is not in the ordinary course, how do we define the arm's length size? So that's all Companies Act related. So you need to review the MVP1 declarations to identify related parties. And as far as declarations, disclosures in AS are concerned, there could be some differences there. From an AS perspective, let's say there could be something which is identified as a key management personnel, but which may not be there in the definition of the Companies Act. But you need to look at both. So from a Companies Act perspective, as well as compliance with accounting standards, AS 18 perspective. Then internal audit, this is something that I'm sure some of you guys would remember. This was there earlier, removed in CARO 2016. Now they've brought it back. Probably the thought process for removal was in Companies Act 2013, they've defined limits as per which the companies are supposed to have an internal auditor. Only if you meet those limits, then the mandatory appointment of internal auditor is required. Probably that's the reason that they've removed it. But now I think they've brought it back, and they've also brought back this clause which says, is it commensurate with the size of the company? Probably one of the reasons why they've brought that back is a lot of companies may be just having an internal auditor for the sake of having an internal audit. So that is why this commensurate with the size becomes very important. So obviously as an auditor, you need to consider the size of the internal audit department, the qualification of internal audit departments, and obviously you need to also review the internal audit reports as per SA 610. So using the work of an internal auditor. So that's something that we need to look at and report here. And if you feel the qualifications are not inadequate, or if the procedures they've done are not inadequate, you can report it. It's advisable to have a meeting with the internal auditors also to discuss the procedures that they've carried out. If there are any non-cash transactions, again, same clause which was there in 2016 brought into 2020. No change here. Non-cash transactions with directors, meaning there's an asset which you've sold it to them in consideration other than cash. All of those we need to ensure compliance with section 192 of the Act. Yeah, this is where we need to be careful. If there is any particular company which has not taken a license from RBI, but is into business of lending. So you need to again evaluate if any of these criteria, where if your total assets versus financial assets, if financial assets are more than 50% or income from them is more than 50% of the total income, then the company is required to be registered under RBI Act. And then we need to look at if there is any NBFC or like company which is not taken a certificate from RBI and started their business. That is something that we need to report here. Then core investment companies, again, specifically there's a definition given by RBI. If you have a license, NBFC license, and if you meet this definition, then the auditor will have to report under this. Cash losses, again, it was there earlier, but now again brought back. In between 2016, they removed it. We need to report if there has been any cash loss in the current year or in the preceding financial year. So again, cash losses are very different from what you report under cash flows from operating activities. This has to be computed separately. This is a simple listing where you start with your profit after tax and you make your adjustment for non-cash items. Whereas in cash flow, we also do adjustments for non-operating items and working capital. So those two are not required. And if there are any cash losses, we report under CARO. This is a new, a new clause that is come in. Resignation of statutory auditor during the year. It has to be reported, including the fact that if the auditor who is signing and issuing this CARO has considered all the objections, concerns raised by the outgoing auditor. So probably again you'll have to look at ADD3 filed by the earlier auditor on resignation. Again, a new this thing with respect to going concern, again complements the going concern assessment done for financials. Again, you need to review the financial ratios, aging, dates of realization of assets, settlement of liabilities, and basis that we need to see if there is any material uncertainty with respect to meeting of liabilities in the next 1 year from the balance sheet date. So that's that. And the last one is on CSR is again, obviously this is for companies where CSR is applicable. If there is any amount that is supposed to have been spent on an ongoing project, then you need to ensure that that is transferred to a particular account. Other than on an ongoing project, obviously we need to transfer it to a fund. So compliance related to that is to be mentioned here. Then the last one is again comments from the subsidiary auditors on the consolidated audit reports. So that's the discussion on CARO. I want to conclude it here. I think we're almost through the time. So we've discussed essays and CAROs. Maybe I think if the members would like it, we can probably have another session for common errors in CARO and audit reports. I think I would want to leave it here. Thank you for this opportunity and patiently listening out to me. I hope all of us have learned something new, and thank you for this opportunity again. Thank you.
Prashanth bhai.
Yes,
Prashanth,
yes.
Even so many restrictions, CARO, RBI rules, regulation, government compliances. Yes. Why the frauds are taking place? I give you example of Punjab Maharashtra Cooperative Bank, where SGI promoter has taken 67% loan from PMC Bank, and today 9 lakhs. 70 days has been taken place for that, and neither RBI is doing anything, neither state government is doing something, not central government. Why the fraud? Why the auditors are signing? Not our Institute of Chartered Accountant. They are not taking any actions. They are silent, mute, silent, nothing more than that. They are least worried about the the investors. People are losing confidence on the banking sector. I tell you, this is my experience. I am chartered accountant.
No, that's totally right, Mahendraji. So obviously, at a larger thing, for the sake of our profession also, I think we need to be very careful, and not just banking. I think I want to also add the fact that a lot of times when we approach private companies, right, when we approach audit of private companies, we take this approach that just because it's the major shareholding is with a particular family or with a particular individual, we think it is okay, but it is not okay. The moment the word limited is added to their entity, our reporting responsibility is to public at large. It is not just to the shareholders of that company. And as an auditor, we always need to be cognizant of that. We are not reporting to the particular director or to the particular shareholder. The moment there's a word limited attached to that, it could be a limited liability partnership or it could be any limited company. Our responsibility is towards public at large. So the distinction between payer of our service and buyer of our service is very important. The payer of service could be the company, but the user of our service, right? Users of our services are public at large, and we owe a responsibility to them. And I think the frauds that you mentioned will come down if we as auditors are cognizant of that fact, that we owe a larger responsibility to public.
Sir, but this is what is happening. Even RBI was conducting audit and they were not able to find out. Last 10 years, they were unable to find out, and they are saying we were ignorant about that. This is a statement of RBI auditors. And our members, they were the auditor for the SDIL as well as they were the auditor of Punjab Maharashtra Cooperative Bank. They never talked of the conflict of interest also. And they were getting the fees of 1.5 crore rupees, and neither our institute is really, I am against all those things. Why institute has not taken action against those people? They are silent on all those issues. They are least bother, institute is least bother about members. Followed now.
But I think just to end it on a positive note, sir, I think right now there are more teeth with the regulators. Earlier it was more of disciplinary committee and all of that. But with a lot of regulations and changes in the regulations that have taken place in the last 3-4 years, now there are more teeth with the regulators. So they can take a lot more stringent action on erring members. So I hope it will get resolved in future.
Thank you. Thank you, Prashanth bhai.
Thank you. Thank you, Mahendra.
Vantilsa, please unmute yourself. Members, I have to make a couple of announcements. We've shared a link on the chat box. You are supposed to give your attendance through that link. Please do not mention your name and your membership numbers in the chat box. There's a link. Please fill up that link, and then only you will be given attendance. All right. And secondly, those of who you wish to get the PPT of this seminar, will be uploading on the branch website. You can download it from the branch website, which is nircamritsar.org. Or in case it's difficult for you to write it down right now, just Google up Amritsar NIRC branch, and you'll be able to find our website. The presentation will be uploaded on the branch by end of day today. All right, Prashanth, please email the presentation to us today.
We'll do that.
All right. Vantilsa, you're not audible.
Iqbalji, you ask if any member is having query.
Members, in case you have any queries, we'll be closing the session soon. We have about 5 minutes. If you have any queries, please feel to ask the speaker, Prashanth. I am sure he'll be happy to help and resolve your queries. We don't have any queries now. So,
Iqbalji, I humbly request you to propose vote of thanks.
Ji sir, thank you, sir. So, members, it's an honor for me to propose a vote of thanks from our very dear friend Prashanth. We've known each other for about 15 years now, since we started our journey in college together in 2005. Prashanth, it was a very well explained session on Caro and standards of auditing. These are topics that a lot of people just ignore and don't consider very important in these days, especially in smaller cities. And you've explained the various clauses and various provisions of Caro and all very in detail. And I'm sure a lot of members and all the members and students who've joined our VCM today are immensely benefited, and all their queries are resolved. And we look forward to having you here in Amritsar sometime physically once the normalcy comes back. And thank you so much for sparing your time and your knowledge with us. And thank you all the members for joining in us today. We had about 150 participants a little while back. Now I'm seeing we still have 108. Please, and also please do mark your attendance. We don't want you to lose out on CPRs despite having attended this session. All right. And Mahinderji, I hope sometime the government does and ICAI also catches hold of all the culprits and all the bad fish are caught and our profession becomes really clean in times to come.
Sir, it is not like that. Basically, so many people has died in 9 lakhs depositors holders are suffering, investors, and they are losing confidence. This is basically, as a chartered accountant, I lead the morchas and everything in Mumbai. You followed now, but nobody is interested. Neither I hold responsible of Institute of Chartered Accountant as well as a Reserve Bank of India. They are not taking action against all this because people has lost the faith in banking sector. Basically, this is my experience as Bombay is concerned. I am from Bombay.
I'm sure so someone, whoever is the concerned person for taking action against such people, he is doing his best. Let's have confidence in their ability and in their integrity as well. And I'm sure things will improve in the times to come. And thank you everyone for joining in. And we'll see you probably next Saturday. We have a session with Ahuja sir. We'll share the details of that on email and WhatsApp as well. Thank you everyone. Thank you.
Thank you so much. Thank you so much.
Thank you.
Thank you, Prashanth ji. Thank you.
Thank you, Prashanth bhai. Thank you, everybody.
Thank you.